Frank, I'm not sure why my loan application didn't get approved. Can you explain what went wrong? Absolutely, Jason. When lenders assess a loan application, they look at what we call the 5 C's of credit. These help them decide if someone is a reliable borrower. Let me break it down for everyone watching. All right. So what's the first C? The first one is character. This looks at your honesty, reliability, and intention to repay the loan. Lenders want to see that you have a track record of being responsible with finances. How exactly do they judge character? Good question. They'll look at things like your employment history, level of debt, assets, resident status, and the purpose of your loan. All these pieces give the lender an idea of who you are as a borrower. Okay, makes sense. What's next? The second C is capacity, essentially your ability to repay the loan. They look at your income, job stability, and assets to see if you can handle the added responsibility of this new loan. So they're making sure I have enough income and stability to manage repayments? Exactly. And within capacity, lenders often look at 2 important ratios: the debt servicing ratio, DSR, and the gross debt service ratio. All right, let's start with the debt servicing ratio. What's that? The debt servicing ratio, or total debt service ratio, TDSR, measures the percentage of your income that goes toward covering debt payments, including the potential new loan. It shows how much of your monthly income is already committed to debt. If this ratio is too high, it may indicate that you have too much debt relative to your income. Jason, got it. And the gross debt service ratio? The gross debt service ratio, GDSR, focuses specifically on housing costs. It's the percentage of your monthly income that goes toward your housing expenses, like mortgage, property taxes, and any condo fees. Lenders usually set a limit on this ratio, around 28 to 32%, to make sure your housing costs are manageable. So DSR looks at my total debt, and GDSR just focuses on housing expenses. Both help lenders decide if I can take on more debt without being financially strained. Exactly. These ratios give lenders a clear view of your capacity to handle loan payments without risking your financial stability. Got it. What's the third C? The third one is credit, which reflects your credit history. Lenders will look at your payment history, your current use of credit, and whether you have any delinquencies or outstanding judgments. So, if I've had issues with credit in the past, that could impact my approval. Precisely. Your past credit behavior is a good indicator of how you might handle debt in the future. They're looking to see a solid, responsible history here. All right, what's the fourth C? That's collateral. This is any property or asset you can use to secure the loan. Collateral provides a safety net for the lender in case the loan isn't repaid. So if I don't pay, they can use the collateral to get their money back? Yes, it's a way for them to minimize risk. Got it. And what's the last C? The final one is capital. This refers to your net worth or overall financial situation. It includes your total assets and indicates your financial resilience. So the more assets I have, the better my capital. Exactly. Having strong capital shows lenders you have a good financial cushion, which makes you a lower risk borrower. Thanks for explaining, Frank. But what happens if I'm weak in one of these areas, like if my credit history isn't perfect? Great question, Jason. If you're weak in one C, lenders may still approve your loan if the other 4 C's are strong enough to offset the risk. For instance, if your credit history has a few issues, but you have stable income, strong assets, good character, and valuable collateral, those strengths can help balance out the weakness. Lenders look at the whole picture. That makes sense. It's good to know that one weak area doesn't have to mean an automatic no. Exactly. It's all about how the 5 C's work together to show the full picture of your financial reliability. I hope this breakdown of the 5 C's of credit has been helpful to everyone watching. If you found this information valuable, make sure to like, subscribe, and share this video. Don't forget to hit the notification bell so you don't miss any upcoming videos. We'll be covering more important financial tips and loan guidance in future episodes. See you in the next video.